and welcome to our next NEP. NEP stands for Nonprofit Auditor Points, and I'm Irina Ryshkova, your nonprofit auditor. I design nonprofit auditor points to provide some information to nonprofits and management, board members and accountants, bookkeepers, some information from the auditor standpoint. I've been auditor for many years, and it's just my way of sharing with nonprofit community. Today, I would like to talk about cash. And specifically, I want to talk about what nonprofit need to retain and do in order to prepare for the audit in terms of cash and cash equivalents. And when I say preparing for the audit, it does not need that your nonprofit need to do it specifically for the audit. Your nonprofit needs to make sure that that information is available regardless whether your nonprofit goes through audit or not. It's a good practice and it's a good accounting. Your nonprofit have to have these documents. So let's talk about it. So what is cash? When we talk about cash, we're talking all about bank accounts that typically include PayPal, your checking account, savings account, maybe your payroll account that you have, and so forth. And this is all considered cash. And cash is one of the most sensitive audit areas we as auditors considering. So when we consider it sensitive, your nonprofit most likely consider it sensitive as well. Why? Because cash is easy to misplace, steal, and do some areas, some things, a lot of fraud happens through cash when the money are stolen because it's very liquid, it's very easy to misplace and steal. So everything goes eventually through cash. If you think about it, all fraud typically relates to cash, one way or another. Sometimes multiple transactions can be recorded in cash, sometimes fraudulent transaction could be recorded, and so forth. So what we do as auditors, we look in the red flags. So again, when I'm saying we as auditors, that's also a good idea for the management and board members to look in the same red flags, regardless if your nonprofit goes through audit or not. So first and foremost, very, very critical, very important to do is to do monthly bank reconciliation for all your bank accounts, even PayPal, and even your saving account that has very few transactions or maybe none of the transaction. Still, reconciliation needs to be done, not because for whatever reason, reconciliation also, it's a good check point where whoever performs reconciliations checking that amount per bank statement agrees with amount per books. So at the end of the month, nonprofits receive bank statements or can access bank statement and needs to reconcile that the amount per bank statement agrees to the amount that is recorded in your accounting system. That calls bank reconciliation, and it's absolutely must be performed monthly, and it's absolutely needs to be performed timely. Those two things are critical. If your nonprofit does it, bank reconciliation timely and regularly, your nonprofit can prevent at least 60-70% of the fraud, mistakes, or dishonest behavior, or maybe even higher. So I would highly recommend for the management, for the board, make sure that your bookkeeper perform bank reconciliations within 10 days, maybe 15 days, the most 10 to 15 days after the month end, every month for all bank accounts, including PayPal. And once bank reconciliation is performed, management or whoever reviews bank reconciliation needs to look at the reconciliations, see what our reconciling items are. Very often your bank balance per bank will not agree with the balance per books because there's some fees, outstanding checks, deposit in transit. So you need to understand and see that there is no unusual transactions. I will call it like man-made transactions that forced in a system make sure that these accounts are reconciled. Again, timely and consistently every month. Sometimes when reconciliation is performed 3 months later, that's not a good practice. It's way too late for the cash. And there is no need, there is no reason to have a bank reconciliation to be performed that late. So that would be a great internal procedure to make sure that the reconciliation done within 15 days after month's end, and it's done regularly every month for all bank accounts. If you do see some reconciling items on a bank reconciliation that have been recorded long time ago and they have not cleared, it means that it's a time to write them off, to obtain explanation of what these reconciling items are, because they typically reconciling items such as fees, undeposited checks, deposit in transit, uncleared checks, they should be cleared every month. So all reconciling items, they typically due to the timing. So if your reconciling items sits there for the period like 3, 6, and 9 and longer months, that means they need to be written off, understood before they're written off why this reconciling item exists. Okay. Common mistakes. Sometimes after reconciliation has been done, bookkeepers or whoever manages the books continue recording cash transactions, and it's not a good practice. So after months is over and cash is reconciled, there should be no transaction recorded to cash after that, because books needs to be closed for the months and cash should not be affected. Also, another area where we as an auditor are paying attention, and you as a nonprofit might also consider, that federal government provides government insurance, we call it FDIC insurance, up to $250,000 per entity, per financial institution. For example, if you're banking with the Bank of the West, for example, and you have 5 accounts, but total on these 5 accounts, let's just have 2 accounts. One account has 200,000 balance at the end of the year, and another has 300,000 at the end of the year. Total is 500,000 because it's all with the Bank of the West, regardless how many accounts you have. So an FDIC only will insure up to 250,000. So if you total with this bank 500,000 and your insurance only 250,000, therefore at the end of the year 250,000 is uninsured cash. If bank collapses or something happens, that's potential risk exposure of nonprofit for not receiving this money. So therefore, we typically as auditors concerned when the organization has a large deposit at the end of the year with one specific financial institution. And we do recommend nonprofits to consider either to diversify, banks put maybe money in other financial institution, or maybe put it in investment accounts and start investing somewhere, or within the bank you can ask your bank to buy certificate of deposits of other banks, and each CD might have their own insurance up to 250,000. One way or another, your nonprofit might want to consider to diversify the risk, right? And regardless of anything that nonprofit and management does, it's always good idea to monitor your bank account. So therefore, monthly review of your bank statements for all bank accounts, including PayPal, and reviewing with the bank reconciliations It's very, very good practice that will allow your nonprofit to manage cash, make sure there is no funny businesses going on, and also great idea to look at liquidity and see overall what is your cash outflow and cash inflow every month, and not just see it on financial statements but on a bank statement, because financial statements are performed on accrual method of accounting, not necessarily cash, but cash is actually show true liquid movement of cash, because on the paper the organization might look okay, but if most of that okay things in non-liquid assets like receivable, maybe long-term receivable, then on cash your organization might lack liquidity and experience some cash shortage. So bank statements are a great idea to review monthly, not idea, it's necessity. Monthly, very carefully to see how much cash is organization is bringing, how much cash is going out from the budget and planning standpoint, and also from standpoint of oversight, make sure that the organization manages its cash wisely and does not allow any funny business with the cash. Thank you so much. Appreciate you being here and looking forward to see you for our next steps. Thank you and be safe.